Welcome back to Gecko Finance channel. This is Artie and let's go. You can see that I'm excited today because a new and fascinating experience is awaiting us. Today we're going to travel to the fantastic world of value investments. So fasten your seatbelts and let's get right into it. Economics legend and award winner John Maynard Keynes believed that prices on everything are determined by people's opinions. But what about profits and all that other boring stuff? Today we're going to figure out what actually affects stock prices and what investors' judgment has to do with it. From the very dawn of human existence, everybody wanted to know one thing, and it is how to predict stock prices and such. But no one has been able to do that, and that incapability gave birth to different types of analysis and research, from technical analysis and cycle search to voodoo magic and astrology. What's your zodiac sign? Leave a comment down below. I'm a Capricorn. Meanwhile, pricing process is not very complicated. For example, stocks and such rise in price if investors want to buy them, and those investors who have already bought them don't want to sell them at the current price. And there you go. And it is only logical that investors want to maintain or increase their income. This logic works in most cases, apart from some questionable schemes and low liquid assets. In these cases, people act irrationally, and we don't want to deal with that. Today we're talking about value investing. What is it? It is an investing principle which is based on finding undervalued securities through fundamental analysis. The goal of it is to find companies whose intrinsic value is higher than its market valuation at the moment. Let's look back in history a little bit. Today, we need to talk about two men, Benjamin Graham and David Dodd. They are known to be the fathers of value investing. Value investing originated in the United States in 1920s and 1930s. Graham's and Dodd's views were formed under Great Depression. Investors wanted to buy stocks at a lower price than the actual assets owned by the company itself. Graham said that as soon as an investor buys such stocks, he immediately gets a safety margin. Because in case if company goes belly up, the investors will not lose anything because he will get compensation. This is a really good approach because if the price of those stocks raises, well, the investor will get profit. But if the company goes belly up, the investor will get more in returns than he actually spent buying those shares. One of the OG value investors is, of course, Warren Buffett. He began investing when he was in his 20s. Later, he became the president of one of the biggest investment companies, Berkshire Hathaway. If you've heard about Warren Buffett before, please leave a comment and tell us what you know. Maybe we can learn something new together. One of his famous sayings is, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett also calls for looking at the internal value of the company first before doing research on price dynamic of stocks and other assets of it. But how can we learn the internal value of the company? Let's find out. Book value of the share. After the stock market crash in 1929, most attention was paid to the value of companies' assets. And when we say value of companies' assets, we mean book value per share. Previously, the main criterion for an investment decision was the difference between the book price of a share and the market price. And in this case, we are talking about PB ratio, price to the book value of the share. A profit with a lower PB ratio is a juicy and attractive security. Because, as I've mentioned, if the company goes bankrupt, you will not lose money because price of the share worth less than the company's property accounted for it. So you take the price of the company property, you subtract price of the share, and you get plus. You get profit. 4 steps: price of the property, price of the share, question mark, question mark, question mark, question mark, profit. Profit and cash flows. Nowadays, the approach to value investing has turned to studying of profits of the company and its cash flows. Companies with a PB below 1 but with a lack of stable profit can turn to selling their property and issuing more shares, thus increasing their debt in order to improve company's affairs. Thus, the book value of the company could continue to decline. So that's why some investors turned to doing research on the company's profit and their cash flows. In most cases, share price depends on the profit of the company. It can be represented in different ways, in the form of net quarterly indicator for the period of the last 12 months, or in the form of EBITDA. Despite the good correlation between the share price and the business income, sometimes investors get too optimistic or too pessimistic. The goal of value investing was to find companies whose price decreased, but whose profit didn't. And we could talk about different variations of those variables. In all cases, we come to decrease in the multiplier PE. Price to earnings, share price to net profit. It's important to note that most investors extended their methods to bigger companies with a well-known and long history on the market. Because chances are that if a company is doing badly on the market, it will most likely stay afloat. Modern view of value investing. So let's go back to Warren Buffett. He once said, if you want to believe in corporate finance, you must believe that the earth is flat. So what does that mean? It means that if you turn to value investing, you automatically assume that the market is wrong about a particular company. And you have to answer a couple of uncomfortable questions. What causes the share price to decline when the profit is either stable or rising? Why do all those people want so desperately sell something that they want to buy? What is my competitive advantage? The answers to all those uncomfortable questions are provided by the modern methods of estimating the fair price of a share. Discounting future cash flows. This is a more complex way of assessing a company's value. It provides a way of calculating intrinsic value of a big, well-established company. For example, those could be manufacturers of essential goods or retailers of those in developed countries. So when we talk about value investing, we need to keep these points in mind if you want to achieve some desirable results. First, diversification. Value investing is primarily a portfolio solution. When you value invest, you assume that the market is wrong about a particular company, but the possibility is that the market is actually right. So if you invest everything in such a company and it does go belly up, you may lose everything. In order to prevent that, we need to diversify, not to lose all our capital. Second point, value investing is a long-term strategy. When the market valuation P over E or EV over EBITDA decreases, the market assumes that there will be a real negative change in fundamental conditions in the future. So we need to be well aware of that. What it means that value investing is a long-term solution, from mid-term to long-term. It is applicable for those people who are ready to stay in stocks for several years. Compound interest. This method involves searching for big and well-developed companies and those issuers that are willing to pay high dividends. You can invest those into the same securities, or you can invest into something with low risk and constant income in order to maximize your profit. And now, let's talk about criticisms of this method. Despite the fact that value investing is pretty reasonable and kind of safe, it still has some constructive criticism attached to it. According to the modern methods of discounting cash flows, investors buy cheaper stocks in hopes that the issuer has already laid all those negative consequences into the investment case. There are three possible outcomes in this scenario, and only in one of them you will make profit. So let's have a look at them. Outcome number one: if market expectations about a company were indeed too pessimistic or some positive changes occurred, well, in this case, the company will recover very quickly and you will get a lot of profit. If market expectations were indeed too pessimistic about the company, you can rely on the recovery of the market value relatively to its internal value. In this case, you will make profit. If the market is right in assessing the future of the company, its revenue indicators will decrease. At the same time, corresponding drop in share prices will no longer occur and relative multipliers will increase. And this is what Graham called safety margin. Of course, no investor can tell how long a particular company will last, but value investors rightfully believe that the management of the company will bring it back to the previous positive earning performance under the influence and pressure of shareholders and other people like that. So that's why it's very important to look for transparent businesses with strong brand. Outcome number three: the market was actually wrong about the company's future. But instead of going back to life, it goes deeper down the drain. So share prices and such fall down and its undervaluation continues to grow. There have been many such examples in history. So the question of what we can actually consider an undervalued company still exists. Another criticism here is that those investors mainly focus on big and well-established businesses. But the economy and technology are developing very quickly, and in the span of 5 to 10 years there will be a lot of big names which could possibly bring you a lot of profit, but they are very little known now. I am talking about companies that could be potential: Google, Amazon, Apple. Even Warren Buffett himself admitted that he probably invested into Apple too late and didn't risk getting into Amazon business. There are also companies that have passed their peak of profit growth. Low multipliers tend to indicate a very modest chance of possible revenue growth. This is the investment case has burned out is already in the price. At the same time, there are future giants and industry leaders like Tesla, Uber, Boston Dynamics, AI robotics company that hasn't yet traded in the stock exchange. They may look not very well known and unprofitable now, but there is a huge potential for growth. But at the same time, the highest profit that a long-term investor can get could be in that kind of story. Naturally, it's worth adding that investing into such companies could be really risky because you never know if they are too optimistic about your future. The value investing is the base for an investor. It is very well suited for those people for whom investing is not their main activity. If you combine this approach with the discounting of the company's cash flows, you will get a clear picture into the investment case. Like any other investing practices, value investing is not without its flaws and risks. But if you combine it with such additional methods like value investing and diversification, you can expect for good long-term results. Well, that's it for today. Like, subscribe, comment, and ring the bell. Make money, multiply money, and be happy. And remember, the world is not all about money, but about its quantity. I will see you later.